Let's discuss all of these factors in more detail. We're joined now by Anthony Chan and also Brian Nick from Nuveen. Anthony, what's your take, first of all, on the trade moves and whether that does lead to more rate cuts?
Well, there's no question that there were many catalysts that precipitated that rate cut yesterday, but the number one leading star was, of course, trade uncertainty. So if anyone wants to nudge the Federal Reserve into cutting rates even further, increase trade uncertainty. And the Federal Reserve certainly has said that if trade uncertainty goes up, they will cut interest rates.
Wouldn't the market applaud that, though?
They will, unless the trade uncertainty gets so high that it actually damages the economy. Remember what the trade uncertainty has done. It has reduced business uncertainty and it's reduced capital spending. If you damage that deep enough, rate cuts are not going to do much. Powell yesterday said that monetary policy is a very blunt instrument and is not really tested to whether or not it can actually deal with this trade uncertainty. So it is dealing with it, but it's not a perfect instrument to deal with it.
Brian, clearly we've seen a sell-off in some of the more high beta, the more risky trades. Are they sold off enough for you to be buying those today?
We're still going to be positioned defensively. That's been our mantra all year. Coming into the middle of the year, we were preferring these more defensive-oriented companies, mainly because we didn't think the market overall was going to do much in the second half of the year. Obviously, when you throw in these kind of shocks like trade policy uncertainty, volatility related to the Fed, it makes it even kind of more desirous to get a bit more defensive in the equity market.
How do you think about this in terms of the impact on consumer spending, which was the strongest part of a strong U.S. economy? Can they weather it?
I think the bond market has spoken. Remember that in the second quarter, the strongest component in GDP was consumer spending. Now you put tariffs on all these consumer products, you are going to reduce consumer spending, which, by the way, was the strongest component of GDP. So guess what? GDP is going to get a little bit weaker. That's the reason why you're seeing the long yield coming down, the yield curve actually flattening. All this is telling us economic growth is going to slow down, no question.
Brian, what's your take in terms of the balance you want to have between domestic and international?
So we had been sort of slightly favoring domestic over international. I don't think today's news changes that all that much. I agree. It seemed like the general pattern is there's some more weight towards domestically oriented companies. I think that's been true throughout the trade wars. And seeing the more contagion you have to kind of overseas developments, overseas risks, that I think certainly elevates the risk in your portfolio. We also don't see catalysts for much higher stock prices in the Eurozone and the UK as long as Brexit remains an issue. And this is going to continue to challenge China and the rest of emerging markets as well.
Brian, Anthony, thank you both for joining us.